Donald Trump has reclaimed the presidency, sparking what many are calling the Trump effect. His return brings back memories of his first term, the sweeping tax cuts that fueled business growth, the trade wars that reshaped global supply chains, the market surges that thrilled investors, and the unpredictable geopolitical moves that kept the world on edge. With Trump's bold approach, his leadership isn't just politics, it's a seismic shift that affects markets, industries, and economies worldwide. So, what does this new Trump era mean for your investments? Now, markets are moving, uncertainty is everywhere, and you're left thinking, what does this mean for my money? Don't worry. Let's break it down in a way that's easy to understand, engaging, and actionable. Stick around, because at the end, we'll show you how to build a strong and simple portfolio that works for you. Donald Trump's return to the presidency has already started shaking up the political and economic landscape. Known for his unconventional policies and bold decisions, Trump's leadership could mean big changes in trade, taxes, and global alliances. But what does this mean for your investments? Let's dive into the specifics. Trump's aggressive spending plans, including potential tax cuts and infrastructure investments, could push U.S. debt even higher, already at $36 trillion. While this might fuel short-term growth, it also raises the risk of higher borrowing costs and global ripple effects. Imagine you're lending money to a friend who keeps maxing out their credit card. That's kind of what's happening with the U.S. debt ceiling. As the government borrows more, over $36 trillion now, the whole world feels the shakeup. Higher borrowing costs, spooked investors, and credit downgrades aren't just U.S. problems, they're global concerns. What can you do? Park some of your savings in short-term bonds. These are like a safe locker for your money, less affected by sudden interest rate swings. Diversify globally. Why keep all your money in one country when you can spread it across Europe, Asia, or emerging markets? Trump's America First approach could mean renewed trade tensions, especially with China, and a focus on energy independence. His support for fossil fuels might boost U.S. energy sectors, while global supply chains brace for disruption. Wars and conflicts might feel far away, but they affect everything from the price of gas in your tank to the chips in your smartphone. Russia-Ukraine, Taiwan-China, Middle East instability. They're all shaking up energy supplies, trade routes, and even currency values. What can you do? Invest in industries that thrive during turmoil. Think defense companies or energy providers. Add some commodities to your mix. Oil, gas, and metals tend to hold their value when chaos hits. Protect against currency swings. If you're holding assets in foreign currencies, hedging can save you from nasty surprises. Trump's policies, such as deregulation and tax incentives, could stimulate business growth but may also lead to inflationary pressures. Combine that with global supply chain issues, and keeping an eye on rising prices becomes crucial. Ever notice how your favorite snacks cost more than they did last year? That's inflation. While prices for some things are stabilizing, housing, wages, and energy costs are still climbing in many parts of the world. What can you do? Look into inflation-protected bonds. They're like a shield for your money, adjusting as prices rise. Real assets like gold or real estate are your friends. They tend to keep pace with inflation. Stick with companies that share their profits. Dividend-paying stocks can be a steady income source. Trump has historically been critical of the Federal Reserve, advocating for lower interest rates to stimulate growth. This time around, his influence might push for rate cuts, which could have significant implications for sectors like tech and housing. Interest rates are like the speed bumps of the economy. Raise them too high, and growth slows. Lower them too fast, and inflation surges. The U.S. Federal Reserve, European Central Bank, and others are walking a tightrope. What can you do? Balance growth stocks, think tech companies, with stable bonds to ride out rate changes. Keep an eye on rate-sensitive sectors like housing or tech. They often bounce back when rates drop. How to build a strong, simple portfolio? Use a trailing stop loss. Imagine having a safety net that moves up with your gains, locking in profits. Set fixed limits. Decide beforehand how much loss you can handle, say 15 to 20%, and stick to it. Adjust based on the type of investment. Risky tech stocks, looser limits, stable utilities, tighter ones. Think of rebalancing like tidying up your portfolio. Every few months, check if your investments are still in the right proportions. If one area has grown too much or shrunk too little, adjust it. Tools from your broker can automate this for you. ETFs, or exchange-traded funds, are like a basket of investments you can buy into all at once. They let you spread your risk across different companies or sectors without needing to pick individual stocks. Why this matters? The world is changing fast, but your investment approach doesn't have to be complicated. By staying informed, spreading your investments, and being disciplined, you can protect and grow your wealth no matter where you are. The key? Start now. Even small steps can lead to big results in the long run.